Alright, hi guys. So in this video, I'm going to show you a technique I use on how to buy 100 shares of stock at less than 1/4 of the cost. So by doing that, it requires a lot less capital and it increases your rate of return. And we call that leverage. Now, bear in mind that this technique should only be used for trading and not for investing. Remember, there's a big difference. In investing, you don't put a stop loss, you hold for the long term. But in trading, you always want to put a stop loss and it's a short-term trade of a couple of weeks or a couple of months. So again, you only use leverage for trading stocks and not for investing. So what's the best way to use leverage? What's the cheapest way? I'm going to show you in this video right here, right now. So let's use Starbucks as an example of a trade. So right now, Starbucks is on an uptrend, and you can see that it recently went through a retracement and it found support somewhere over there. Looks like it could be going back up. So if you're bullish on Starbucks, you would buy right here. Now the current price is at roughly 112.56. That's yesterday's closing price. Of course, when the market opens later, it could be slightly higher or lower. But we can plan the trade first. So let's say we buy at 112.56 and our profit target is 120, just above the previous swing high. So that gives us a potential profit of about $8 per share, right? Now again, it's a trade, so you got to put a stop loss. So let's put a stop loss, say, right below those previous swing lows at, say, 108. It's our stop loss. So again, between 112 and 108, that's about a $4 risk per share, right? We call this 1R, we call this 2R. So we are risking $4 to make $8. That gives us a positive risk to return ratio. Remember, in trading, you always want to risk $1 to make more than $1, right? Risk $1 to make $2, for example. So if you do that, even if you're right half the time, you are making money. All right, so how could you execute the trade? So the first option is to buy the shares directly. Buy 100 shares, for example. How much would it cost you in terms of capital? Let's take a look. So I'm going to click on trade. And I'm gonna put 100 shares. You can see 100 shares there, right? And we're gonna buy at, say, 112.56, which is yesterday's closing price. Again, it could be different when the market opens, but we'll use yesterday's closing price as the price. All right. So click confirm and send, and you can see what's the cost of the trade. So the cost will be 112.56 per share times 100 shares. Total capital required would be $11,256, right? 11,256. Let's note that down over here. So again, the first option is to buy the stock. So when we buy the stock, it's going to cost us a 112.56. Okay, oops. Times 100 shares. So capital required, $11,256. All right. Okay. Now, let's take a look at the profit and loss graph. So there you go. So whenever you buy shares of stock, notice the profit and loss graph is a straight line. All right. So if the price goes up, you make more money. Price goes down, you lose money. Really simple. Again, what's the current price right now? 112.56. That is the current price right here. Now, on the y-axis, you can see the profit and loss. So this is break even. Anything above that is profit, and below that is loss. On the x-axis, you have got the stock price. So right now, the stock price, 112.56, right? Okay, now what's our profit target? We are hoping the price is going to go up to 120. So I'm going to adjust this to 120 here. Right, so that's our profit target at 120. And again, our stop loss was, let me double check, 108. That's right. Okay, so our stop loss is 108 somewhere there. There we go. Okay. Oops. Let me drag this again. 120. Okay. So we are buying here. That's our profit target at 120 and our stop loss at 108. So question, if it goes to 120, how much do we make? We make $8 profit times 100 shares, right? That's $800 profit. Let's write that down. So that's the capital required. This is the capital. Let me write this down. Capital required for 100 shares of stock. Okay. So the potential profit we're looking at, if it goes to our profit target, would be $8 profit. 120 minus 112.56, roughly about $8. Let's take a rough figure, right? Times 100 shares. So our profit would be $800. Now, what's our ROI, our return on investment or return on our capital? It'll be $800. We're making $800 divided by the capital of 11,256. So what's that? 800 divided by 11,256. Boom! That's 7%. So we're looking at a 7% return on capital from buying the stock. Now again, the question is, how could we use less capital and increase the rate of return? Well, we have to use leverage. Now, there are many ways to use leverage. So one of the most common ways people leverage is by opening a margin account, which means you borrow money from the broker to fund half your trade. Now, the problem with margin is usually the broker will allow you to leverage up to 2 times your capital only, which means you still have to pay for 50% of the 100 shares. And the broker charges you interest on the borrowed money. So that's the disadvantage of using margin. So how could we leverage without having to pay interest to the broker? And how could we leverage up to 4 to 5 times? Well, some people think, hey, how about using options? And a lot of people, they may think of buying call options to leverage. And I'm going to show you why that's not a good idea. But let me show you why right here, right now. So if you buy a call option, what happens? Now again, for those of you who have no idea how to trade options, please watch my introduction to options video on YouTube. Just search for introduction to options, Adam Khoo, watch the video, understand the basics of options. All right. Okay. So first I'm going to show you how to buy a call option and why that's not the most effective method. Right. Okay. So to buy a call option, we go to our option chain and we choose a date to expiration. Now, remember that our profit target is 120, right? Which means we are looking to get an $8 move. So how many days would it take to reach $8? Well, you can see from this tab that it will take you roughly, can you see 8.243, right? So this tells you that it will take you 46 days. It will take 46 days for the price to move by $8, either up or down, right? So that tells you to buy an option, you have to buy an option that expires in 46 days or longer. So let's take 46 days, which means this option expires on the 30th of July in about a month, okay? So we're going to open that and we're going to buy a call option at the money, which means we're going to buy a call option with a strike price at the current price right now. So 112.56, the closest we can get would be, say, 112. So you can see that this option will cost $475 per share. Again, one contract is 100 shares, so multiply by 100. So to buy one contract will cost $475. Hey, seems like a good deal, right? Instead of $11,000, now I only have to spend $475. So I'm going to click on that. Boom, there we go, 475. Again, just to show you, if I click confirm and send, you can see again, what's the cost of the trade? The cost is 475 plus 50-cent commission. Bastards. Anyway, all right. So total cost 475.50. That's the cost of buying a call option. So to a lot of people, it seems very attractive because it's relatively cheap versus 11,000 to control the same 100 shares, right? 100 shares, I only need 475.5. So let's put that in. So to buy this call option, again, what's our cost or capital required? 475 times 100 shares. One contract, always 100 shares, will be $475, and those the broker will charge 50 cents commission, right? So that's the total cost of the trade. Now, again, what's the profit that I could make from this if it goes to 120? So for that, let's take a look at the Analyze tab. So I'm going to analyze the trade. So once again, this is the current price of Starbucks, 112.56. We're hoping it's going to go to 120. And of course, it could drop to 108. That's our stop loss price. So again, question, if it goes to 120, how much money do we make by buying the call option? We can look at the chart. So again, this purple line tells you the profit and loss on the date today, which is the 14th of June. Now, as time passes, the call option will lose value. It will lose value, lose value, lose value until it reaches the green line, which is the profit and loss at the expiration date. So you can see that as I move this date forward, look at what happens to the purple line. The purple line will start to fall. As you can see, it's losing value until it eventually becomes the green line at expiration, which is in 46 days, which is 30th of July. So let's assume that it takes 46 days to reach the profit target. So how much money would I make? So look at the box on the left, and you can see when I point here, you can see the profit is 333.87, right? 333.87. Let me put that in. Okay, so again, our potential profit would be 333.87 if it reaches the profit target on the expiration date, which is in 46 days, right? So in this case, what's the return on investment or the return on capital? So it'll be, oops, how did that happen? It'll be 333.87 divided by the capital used, 475.50. That would be, let's see, 333.87 divided by 475.5. That would give a 70% return on capital. So you could be saying, hey, buying the call option looks like a good deal because number one, I use less capital. Instead of using 11,000, I'm now using only $475. Number two, my return from 7% is now 70%. So seems really attractive. But here's the problem with buying options. The problem is that options are decaying assets, which means every day that passes, the option loses value. It loses time value. And so what happens is that if you buy a call option and the price doesn't move up, you can lose everything. That's right. You could lose the entire $475. Whereas if you just buy the stock and the stock doesn't go up, you don't lose money. If the stock stays where it is, you don't lose money, right? But for options, if the stock stays where it is, you lose all your money. So when you buy call options, not only must you be right on the direction, but you must be right in the time as well. In other words, for this option, it expires in 46 days. So in 46 days, if the price doesn't move enough, you lose money. So for example, if you take a look at this chart again, notice what happens, right? Again, remember, anything below zero is losing money, above zero is a profit. So right now, Starbucks is at 112.56. Now, notice that in order to break even in 46 days, that's the break even point. So Starbucks has to go up to about 117, from 112 to 117, just to break even on the cost of the option. Remember, the cost is $4.75, which means the option, that means the stock price must move up by $4.75 for you to break even on buying the option. And that's why most people who buy call options, they could make money once in a while, but in the long run, they always lose money. Why? Because you can't always be right within that 46 days. And notice again what happens if the price stays where it is. That's right, you will lose $475. So how do we avoid this problem? How can we leverage without paying interest to the broker and without the risk of losing time value? The answer is to buy a call option and sell a put option at the same time. That's right. Here's how it goes. So let me show you what I mean. Write this down. This is something that's going to change your trading life. Okay. So again, this technique involves, I repeat, buying a call option and selling a put option at the same time, at the same strike price, at the same expiration date. Why? Now remember, when you buy a call option, you have to pay for the premium, right? Money goes out. But when you sell a put option, money comes in. You're collecting premium. So the genius is this. The genius is the money you get from the put option is used to pay for the call option. So net, what's the cost of the trade? The cost of the trade is near zero. It's a zero cost trade. Isn't that fantastic? Right? So let me show you how it works using the charting platform, right? Okay, so again, we can choose any date to expiration because like I said, the cost is going to be near zero anyway. So we could choose 46 days to expiration, 67 days, it doesn't matter. But let's choose 46 days for consistency. Now again, what strike price do I use? I use a strike price which is near the current price, which is now 112.56. So I could either choose 112 or 113. Either is fine, okay? So if I choose the 112 strike price, notice what happens. Again, recall, I'm going to buy a call option and I'm going to sell a put option at the same time, right? So when I sell a put option, I collect money. I buy a call option, I pay money. So if I choose the 112 strike price and I sell a put option, I collect $3.57. And if I buy a call option, it will cost me $4.25. All right. So is this $3.57 enough to cover the cost of this? No, not enough. So I will choose 113 instead. So if I choose 113 strike price, I sell the put option, I will collect $4.22 in premium, right? And if I buy the call option, it will cost me $3.67. So is $4 enough to cover the cost of the call option? Yes, in fact, it's more than enough, right? So again, I'm going to sell this 113 put and buy the 113 call. How do I do that together? I can do this. I can go to 113, right click, buy synthetic. This is known as a synthetic stock position. Boom, there we go, right? So can you see? Plus means I'm gonna buy a call and minus I'm gonna sell a put. And what's the net price? The net price is minus 55 cents. So what does minus mean? Minus means I don't pay for the trade. I collect money from the trade. It's a credit. That's really cool, right? So I enter the trade. Not only does it not cost me money, but I get paid to enter the trade. So this is a brilliant strategy. Brilliant strategy. So let me show you how it looks like. I'm going to click on confirm and send. Boom. So again, what is my cost of the trade? My cost is a credit of $55, which means the broker is going to pay me $55 to take the trade, right? I pay $1 in commission. So net, my credit is $54. Okay. Now, again, I repeat, the cost of the trade is free, and in fact, you're paid to take the trade. But of course, this trade requires collateral, and the collateral it requires, you can see what we call buying power effect, right? Buying power effect is 2621, which means the broker will block $2,600 of capital in your account for the trade, but this is not what you're paying for the trade. You're paying zero and you're collecting $54. Does it make sense? All right, so 2621 is the capital that is locked as collateral. All right, so let's put that in 2621. So again, by doing this, my cost is actually zero. In fact, I'm receiving $55. Thank you, Mr. Broker, right? But the capital required to take the trade in terms of the collateral is, what's the collateral again? 2621.5. Okay, 2621.50. That's the capital required. Now, what does the trade look like? Let's take a look. So I'm going to do the Analyze tab. Boom. And this is exactly what it looks like. Okay, 113. There we go. Okay. Now, notice something interesting. This is called the combo. Notice it's a straight line. So notice that the profit and loss using this strategy is exactly the same as buying 100 shares of the stock. Check it out, right? So notice if I click on combo here, boom, that's the profit and loss. If I buy 100 shares of stock, boom. Can you see it's exactly the same? So I repeat, buying a call and selling a put at the same strike price is equivalent to buying 100 shares of stock, except you don't pay for the 100 shares, you are paid money to enter the trade, right? It's bloody brilliant, right? Now again, if the price of Starbucks goes to 120, how much money do I make? I make 120 minus 112, that's about $8. Times 100, that's about $800, right? So if it goes up, I make about $800 in profit, okay? And the great thing is that if Starbucks doesn't go up, if it stays where it is, I don't lose any money, right? Because there's no option decaying, all right? But of course, if Starbucks goes down, of course, I lose money, just as I would if I buy the 100 shares. But again, remember, I've got a stop loss over there, so I'm going to cut my loss the moment Starbucks drops to 108. So in other words, let's now take a look at my profit and loss. So what's my potential profit? It's roughly about $800, okay? I know it's slightly less than that, but let's round it off to $800. So what's my return on capital in this case? So in this case, I'm getting $800 profit out of 2621.5, which is the collateral block from my account. That gives me a return of 30%. Okay, so let's compare this method to buying 100 shares of stock. So again, if I buy 100 shares of stock, it will cost me $11,000 of actual money, right? But by using this method called a synthetic position, it will only require $2,000, right? Which is about 25% of the full amount. So again, like I said, you only have to, you can buy 100 shares of stock at 1/4 the cost, right? That was what I told you at the beginning. And that increases your return on investment to 30% from 7% to 30%. And the best thing is there's no time decay and you don't have to worry about the options expiring worthless. Now, if you think this is cool, this is only one small part of the entire strategy, right? So in the advanced options course, which I teach together with Bang Pham Van, we have developed even more powerful strategies where besides doing this, we buy a put to protect the entire trade. It's called a bull bang strategy. And we even sell a call above at the profit target. So this is what we actually do in the advanced course. Let me repeat that again. We buy a call and sell a put at the same strike price. This is equivalent to buying 100 shares, right? At the same time, we buy another put as a protection and we sell a call up here, and this call is used to pay for part of the put. We call this a bull bang collar strategy, and it's one of the most powerful strategies that's used by our students in our community to generate consistent profits. So if you want to learn more, check out our courses at piranhaprofits.com. I do hope this has been a great introduction on how we can use options to structure really profitable trades at very low cost. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.